Hello, my name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's special presentation. Our founder, Dr. Bart DiLiddo, has presented the 7 secrets to making money with VectorVest many times over the years, and it's always a powerful and educational experience. Recently, my friend and colleague, Mr. Steve Chappell, did a special presentation on the 7 secrets to making money. That was done just a few months ago on December 27th of 2019. I urge you to go back into the Views tab and watch that special presentation. It was a great one. In this special presentation, I'm going to focus on secret number 5 of the 7 secrets, which is learn to trade options. So why should we learn to trade options? Well, first of all, options provide you with a great versatility and flexibility that is a wonderful addition to your arsenal for your investments. Specifically, options provide leverage, which I'll illustrate in just a moment. They reduce risk, lower costs, generate income. Those are specifically for covered calls, allow you to lower costs of stocks that you own. You can generate steady income, and you can increase alternatives. In other words, you can profit whether the market's going up, going down, going sideways. Again, the versatility of options is a fantastic system to help grow your portfolio. But to do all of that, they must be used properly. And that's why we're here. Let's start with providing leverage. Margin accounts with your broker provide roughly a 2-to-1 leverage, sometimes a little more depending on your broker or the stock. But the thing with leverage is that it increases both risk and reward. So in the standard margin account, leverage can work both ways. However, options provide us roughly with a 10-to-1 leverage, and they can reduce risk when used properly. Let me show you what I mean by the 10-to-1 leverage. What we say, generally speaking, if we look at a stock, and I'll use IBM from the options chain here, and we look out 6 months out to the option, the at-the-money call option in this case, on IBM 6 months out. Assuming no abnormal volatility skews, we say that the price of the underlying option 6 months out is generally going to be 10% of what the cost of the underlying stock is. And we can see that here. This screenshot was taken just this week. IBM's trading at 116. If we look at the September 115 call option, the mid price there between that bid and ask was $11.70. So while it would cost you over $11,600 to purchase 100 shares of IBM, here you could purchase the control of 100 shares of IBM for just $1,170. Now, understanding how to trade options is important right now more than ever given the current volatility in the market. And what I have here is a market timing graph to illustrate that. I have noted here back, if you remember, the end of 2018, what began in October of 2018 and ended on Christmas Eve of 2018 was that huge sell-off that we saw in the market, just under a 20% sell-off, S&P 500 and roughly in the VectorVest composite, which is what we're looking at here. Now we found those lows late December, early January. And what I have down in the subgraph here is the buy-sell ratio. Historically, when the VectorVest buy-sell ratio is down at 0.20 or less, we say that the market is in an oversold condition and searching for a bottom. And as you can see, it doesn't mean just because it touches that it automatically will blast off, but we do know that eventually that bottom will be found. And as you can see, it's happened several times this year already. And I note that date because as of now, we have given back all of the gains we've had since late December, early January of 2018 and 19, and we are currently right back to where we started. So we once again have seen the buy-sell ratio down well below 0.20. Now again, that's not to predict that this blast-off phase will occur. There's no way to know exactly when it will happen. What I'm going to do is be sure to watch the VectorVest views, look at the color guard every day, and find the indicators that tell us that the market has found its bottom. And that's when the market begins to go up again, and VectorVest will be there to tell us when. My goal in this presentation is to have you prepared for when that happens. So with that parallel in mind, let's go take a look at a case study using this situation from the end of 2018, early 2019. And I'm going to use Apple as our underlying stock, and let's walk through a scenario. The scenario has us buying 100 shares of Apple at $145 on January the 4th, 2019. Why is that? Well, as I noted, remember Christmas Eve of 2018, we hit that low on Christmas Eve. Apple actually bottomed out on the 3rd of January, but we got a green light in the price column on January the 4th, giving us that indication that it was okay to buy stocks, or in this case, buy Apple is going to be our example. The stock was trading right around 145 on January the 4th of 2019, so we went out and we bought ourselves 100 shares. The scenario I've set up has us selling Apple just a couple of months later on March the 15th at $186 per share. And I'll explain why I chose March the 15th in just a moment. So that return, just about a little over 2 months, gives us a $4,100 profit, or a 28.25% return on our investment. Now that's a great trade. That looks wonderful, right? That's a fantastic move. When you align the market trend along with a good quality stock, it did what it was supposed to do. Now, let me compare that with the same time frame, but instead of going out and buying 100 shares of Apple, what if you were able to use the power of leverage and go out and buy one Apple March 145 call option? That's the expiration date, would be the third Friday in March. 145 is the strike price, and the option is the call option. So we bought the right to buy 100 shares of Apple at 145. And to do that, we paid $10.50 per share, or for one contract, what would be $1,050. So instead of laying out the $14,500, we're laying out only $1,050. At expiration, our Apple March 145 call was worth $41 per share. Now that's a $3,050 profit, but it's a 290% return on our investment. That is the definition of leverage. Let me show it to you in a little bit of a different way here. On this table, I compare buying that same scenario, buying the 100 shares of Apple. We'd pay $14,500, stock trading at 145. The value of that position on March the 15th was $18,600, giving us a net profit of the $4,100 that we showed on the graph and a 28% return. Again, that's wonderful. We also showed on the graph the comparison of buying one contract, which gave us that 290% return. But what we notice is that, yeah, okay, it's less of a profit. But what happens if I go out and buy 3 contracts at $10.50 a share? It's going to cost me $31.50, roughly 1/5 of the amount it would cost me to buy the 100 shares. On March 15th, the value of my 3 contracts would have been $12,300. My net profit is $91.50, and again, a 290% return on my investment. So go to 5 contracts and you can see how that works. So for roughly a third of what my cost outlay would have been for the 100 shares, my position's worth $20,500. That's a $15,250 profit. Divide that by my cost basis and it gives me a 290% return on investment. That's the power of leverage. Now these explosive phases happen a few times a year and you certainly want to be ready for them. Another reason we want to learn how to trade options is to reduce risk. As I just showed, leverage kind of segues into reducing risk because we're laying out less capital and thereby reducing our risk in that fashion. But we can also reduce risk by understanding how to buy put options to protect individual stock positions or your entire portfolio. We can also use option collars to protect individual positions. So I just want to walk through a couple of examples on how you can reduce risk. Fidelity National was a position that was held in our Tuesday retirement coaching group session. We purchased Fidelity National on January the 22nd of this year, 200 shares at $47.56. The market trend was up. There was a spot open in our portfolio and we bought 200 shares of the stock. It started out doing what we needed to do, but it gapped down a bit. Now that gap looks worse maybe than it is because you have to realize the log here, there's only $2 increments here. So you always want to check that when you look at the movement on a stock. So it basically gapped down back to where we had purchased the stock. However, the stock did continue to move down, and because we do our due diligence on every stock that we own, we knew that on February 14th that earnings were going to be announced. And so we want to be proactive, and again, this is an example of the protective put. So what we did was went out and bought on February the 11th the March 45 put options at $1.05 per share. So if you bought two options, that's $210 for two contracts to protect what at this point was just under a $10,000 asset. On March the 10th, in this actual trade, the entire position was closed on March the 10th. This is our Profit Locker Pro stop. The stock had fallen below our stop criteria that our system sets up for us, but the reason the stock wasn't sold earlier was because simply we had the put option in place, which worked as our stop. So on 310, the entire position was closed. Well, what happened? We sold 200 Fidelity National at $38.52, and we took a loss of $1,808 on the underlying stock. But because we were proactive, we bought those options. At that point, we would sell the two March 45 puts at $7.30. Remember, we only paid $1.05 for them. So selling those two puts at $7.30 would net $1,250, which leaves us with an overall loss on the position of just $558. We mitigated that loss tremendously by being proactive and protecting the position in a downtrending market. Next, I mentioned the collar trade. So I just wanted to illustrate the collar trade here quickly because this was also a stock that was purchased on the same date in that same portfolio. 100 shares of Ross Stores at $118 was purchased. Now the stock kind of fluctuated here, traded as high as $123 per share. But again, because we do our due diligence, we knew earnings was coming up and that they reported on March the 3rd. So on February 25th, we took the following action. We sold a covered call. We sold one March 125 strike call option, and we took in $1.60 per share, or $160. We then took that $160 and we put it towards the purchase of a put option, the March 115 put. So by buying that put option, it buys our insurance or our protection on the underlying stock. It gives me the right to sell Ross Stores at $115 per share. That right costs $3.50 per share. But instead of paying $350 for the put option, we applied the $1.60 and it only cost $1.90 to insure at this point, which was roughly a $12,000 asset. For $190, we were able to achieve the following. As I said, earnings were reported on the 3rd. The stock did move down. This was our stop criteria here. It fell below, and ultimately this position was closed on March the 5th. Well, what were the results of that closing trade? Again, with the market in the downtrend that it's in, we sold 100 shares of Ross Stores at $102.29. That's a $1,576 loss on the stock, and would have realized that loss had we not been proactive. But because we bought that put option at $3.50, the value when we closed the position was $999. The value of the option was $13.40. So we sold it and we profited $990 on that insurance policy. We were also able to buy back the call option that we sold at just a nickel. So we got to keep $155 of the $160 that we took in when we sold the call option. Now that leaves us with a loss overall in this position of just $431. Again, roughly just a third of the loss we would have realized had we done nothing. Now that's $431 on this trade, $558 on the previous Fidelity Financial trade I just showed you. So that's $989 of losses on these two stocks in a market that sold off so violently there. We compare that to what would have happened had we not been proactive, where we would have lost $3,384. That's the $1,576 here and the $1,808 on the other stocks. So That's the difference of being proactive and using the power of options in any type of market. Which leads me to this. You can buy put options either for profit in a downtrending market, the same way I showed how you can make money in an uptrending market by taking advantage of the market trend and that blast off phase. You can also be prepared for times like these that we see in the market. You can buy puts, whether it is simply to profit as a trade from a falling market, or you can buy puts for portfolio protection. Right? So whatever your objective or rationale is, the outcome is the same. Now, this final case study I want to show just has us on February the 24th, just a few weeks ago, the DEW timing system in the VectorVest program, the signal went to a down situation. Now that's a good time to place a put option on the SPY. You can do it on an individual stock if you want to just profit from a crummy stock going down in a downtrending market, or you can do it on the SPY, which is the ETF that tracks the S&P 500. Now, whether you're looking to profit in a downtrending market or simply being proactive to place an insurance policy on your entire equity portfolio, this is the way to do it, understanding the put option. So in this scenario, on February 24th, you could buy one April 322 put. That's where the SPY was trading, again, just a few weeks ago. And it would have cost $9.75 per share, or just under $1,000 to place this position as insurance or as a trade. Well, we know what's happened, and it's still happening, and it's just a few weeks later. But as we speak, that put is currently trading at around $71 per share. Now that, of course, will fluctuate through a volatile day, but as I record, that's $71 per share. That's a profit of 61 and a quarter per share, or $6,000, which translates to 628% return on investment. So secret number 5 tells us why we need to learn to trade options, as we went through, to reduce risk, provide leverage, the ability to profit in an up or downward trending market. Those are very valuable skills to have. We say here at VectorVest often, and I believe this for an options trading system, whether it's equities or retirement portfolio or anything in life, quite frankly, your system is going to determine your success. In this case, when it comes to options, you have to have a system in place. There are basic foundations that you have, and every one of them are every bit as important as the previous. You have to be able to recognize market direction. You have to be able to find the proper underlying stock. You have to know which option is the best for your rationale or objective for placing the trade. You need to know how to set up that trade, and then perhaps most importantly, you need to know how to manage that trade once you hit the enter button. So your system determines your success. And that's what makes secret number 5, learning to trade options, so important now more than ever. So if you're interested in learning more about learning to trade options, you can stick around for an extra minute or two and I'll tell you all about the Options Jumpstarter, 6 Weeks to Profitable Options Trading. It's a complete step-by-step system that shows you how to buy calls and puts to profit in both up and down markets. We'll take you by the hand and guide you through the exact step-by-step option profit system that you need so that you can leverage your money with options. Now, the outcome of this course is that the next 6 weeks you'll be able to confidently find, set up, and manage the right option trade at the right time so that you can make money again, whether the market's going up or down. So if you're new to options or have struggled with them in the past, this is the course for you. We put it together for people who want a system to trade options the right way. We've got 6 modules in place that talk about all of those, that flow chart I just showed, building that foundation, understanding all the terms, trade setup for both calls and puts, trade selection, management, and as I said, that may be the most important part. Once you enter the trade, how do you manage the trade after? So a lot of important points in this 6-module course. Now, along with the course, we do have some added bonuses I just want to share with you. After the 6 modules are done, again, going through that flow chart and teaching us the important concepts, we have a bonus module on covered calls. We'll show you how to generate consistent income every week, get paid actually to own your stocks, and you can profit even when the market kind of moves sideways or starts to stall out a bit. Here's my favorite bonus that we're offering. It's a live stream version of the Options Jumpstarter course. You'll get all of the training in just one day, a live stream from our state-of-the-art training center. You can ask questions during the session to solidify your understanding, and you'll get an extended Q&A session after the live stream. And if you can't make the live stream, you will get a recorded version, and you'll have access to that recording for a full year along with the rest of the course. Also, if you sign up for the Mastery Package, we'll help you implement what you learn via live Mastery support sessions. We have 6 of them, 1 for each module. We can look while the market's open at what you're doing, help to guide you. And don't worry, again, if you can't make it, we do have each of these sessions are recorded and will be archived for your review. So if you join before Monday, March the 16th at 5 p.m., you will get our Mastery Package, which is our best value. We have 2 choices. In our self-study package, you'll get the full Options Jumpstarter course. You'll have 1-year access to the digital course. You'll get the bonus of how to trade covered calls, and that's all at $295 for the self-study package. The better value, we believe, is the Mastery Package at $495. Now that's our early bird pricing. Order before Monday, March 16th at 5 p.m., and you'll get that $495 price. That the price will go up Monday afternoon. But here you get all of the things you get in the self-study package, but you get the live stream, you get the bonus modules, as well as the Mastery support session. So go to VectorVest.com/jumpstart, choose Mastery Package, and the registration process will prompt you through the steps to get you registered. And one last point, please keep in mind this is a 100% money-back guarantee. They say there's no such thing as a risk-free trade in the markets. Signing up for the course actually is risk-free, because if you take the course, go through the work, and don't find it to be what you expected, we will gladly refund you for the price of the course. So thanks again for joining me for this week's special presentation, secret number 5, learn to trade options.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.